trading floor fell silent as the numbers flashed red across every screen. Bitcoin, $60,062, down 50% from its all-time high of $126,000 just months earlier. It wasn't just a correction, it was a bloodbath. Institutional investors who had championed the digital asset were now abandoning ship, with over $3 billion fleeing spot Bitcoin ETFs in January 2026 alone. In the distance, the rumble of economic thunder grew louder. This wasn't the first time Bitcoin had faced existential threats. Since its quiet birth in 2009, amid the smoldering ruins of the great financial crisis, it had been declared dead 476 times by mainstream economists. Yet each time, like a financial phoenix, it had risen from the ashes, stronger, more resilient, more integrated into the global financial fabric. But this time was different. This wasn't just about Bitcoin's price. The entire financial system was trembling. History teaches us that systemic collapses rarely have a single cause. Like the intricate domino arrangements of financial artist Robert Kinsman, they require precise positioning, external pressure, and a triggering event. The positioning had been years in the making. By 2025, global debt had swelled to $390 trillion, more than 4 times global GDP. The Federal Reserve's balance sheet, despite numerous promised reductions, had ballooned to $12 trillion. Traditional banks, desperate for yield in a world of persistent negative real rates, had quietly accumulated cryptocurrency exposure through a web of derivatives and specialized investment vehicles. The pressure came from multiple fronts. Kevin Warsh's controversial nomination as Federal Reserve Chair signaled a hawkish policy turn that the markets hadn't anticipated. China's property sector, after years of government life support, finally flatlined. And in a digital Pearl Harbor, a state-sponsored attack compromised 3 major cryptocurrency exchanges simultaneously. The trigger was deceptively small. On February 1, 2026, activist shareholders mounted a campaign to unseat Grayscale Investments, the manager of the world's largest Bitcoin investment trust, citing billions in losses from excessive fees. When the largest investment vehicles face internal revolt, noted financial historian Dr. Sarah Krishnan, it underscores the systemic vulnerabilities that can emerge even in a non-crisis correction. Markets don't just reflect reality, they create it. The Grayscale news, insignificant in isolation, provided the final push that sent the first domino toppling. What makes systemic collapse truly terrifying is contagion, the spread of financial distress across seemingly unrelated sectors. In 1929, the infection traveled through margin loans. In 2008, it was mortgage-backed securities. In 2026, the pathogen was algorithmic liquidity. As Bitcoin plunged, automated trading systems triggered sell orders across all cryptocurrency markets. Ethereum dropped 24% in a week, while Solana crashed 26%. With over $800 billion in value evaporating in days, margin calls forced liquidations of other assets. Gold and silver, traditional safe havens, unexpectedly plummeted as investors desperately raised cash. The most damaging contagion vector, however, was psychological. Trust, the invisible foundation of modern finance, evaporated overnight. During a systemic collapse, explained former Treasury Secretary Janet Yellen in her seminal 2023 paper, the question isn't what assets are connected on balance sheets, but what assets are connected in people's minds. By February 7th, the correlation between cryptocurrencies and supposedly uncorrelated markets approached 1.0, perfect synchronization in a ballet of financial destruction. To understand whether Bitcoin would survive this collapse, we must first understand what makes a financial system resilient. History offers instructive examples. The Roman monetary system survived for over 500 years because of its distributed nature and physical backing. The Medici banking network endured for centuries through its innovative double-entry bookkeeping and relationship-based lending. The Swiss banking system weathered 2 world wars by maintaining neutrality and secrecy. Each resilient system shares 3 characteristics: distribution of power, alignment of incentives, and adaptive capacity. Bitcoin, unlike any previous monetary innovation, embodies all three. Bitcoin's fundamental architecture, a distributed network with no central point of failure, makes it uniquely suited to survive systemic shocks, noted digital economist Satoshi Armstrong. While centralized financial institutions can be crippled by leadership failures, regulatory actions, or liquidity crises, Bitcoin's consensus mechanism continues relentlessly, producing a new block every 10 minutes, regardless of external conditions. This architectural advantage became evident as the crisis deepened. While traditional exchanges suspended trading and banks froze withdrawals, the Bitcoin network continued to process transactions, slower and more expensive, but uninterrupted. As Bitcoin's price collapsed through psychological support levels, $70,000, then $65,000, then $60,000, market commentators predicted its imminent demise. Yet beneath the price chaos, Bitcoin's fundamental metrics told a different story. Network hash rate, the computational power securing the blockchain, dropped only 18%, suggesting that most miners remained profitable or were willing to mine at a loss, confident in future recovery. Transaction volume actually increased 27%, indicating continued utility during the crisis. Most tellingly, Bitcoin's distribution continued to improve, with addresses holding more than 1 Bitcoin reaching an all-time high. This resilience wasn't accidental. It reflected Bitcoin's design as a response to the 2008 financial crisis. The Genesis block itself contains a Times headline about bank bailouts, a built-in reminder of Bitcoin's purpose. As historian Niall Ferguson observed in his 2020 analysis of financial technologies, every monetary system embodies the anxieties of its age. Gold reflected fears of royal debasement. Fiat currency embodied industrial-era trust in government expertise. Bitcoin encodes distrust of centralized financial authority itself. This ideological foundation provided something central banks couldn't create: conviction among its users that transcended price fluctuations. Systemic crises force impossible choices on policymakers. In 1929, the Federal Reserve's commitment to the gold standard prevented monetary expansion. In 2008, moral hazard concerns initially prevented bailouts of Lehman Brothers. In 2026, the dilemma was even more acute: how to contain cryptocurrency contagion without legitimizing assets that threatened monetary sovereignty. The initial response was predictable. Securities regulators suspended trading in Bitcoin ETFs. Central banks injected liquidity into traditional markets. Politicians called for emergency legislation. But as the crisis accelerated, policymakers faced an uncomfortable reality. Traditional tools couldn't address Bitcoin's decentralized nature. You can't bail out a protocol. You can't nationalize a distributed network. You can't negotiate with a mathematical algorithm. The critical juncture came on February 12th, when the Federal Reserve announced a coordinated intervention with the European Central Bank, Bank of Japan, and People's Bank of China. But instead of direct purchases of cryptocurrencies, which many had expected, they unveiled a central bank digital currency accord, a framework for rapid CBDC deployment, with a standardized bridge protocol for interoperability with private cryptocurrencies. This represented a profound shift in institutional thinking. Rather than trying to destroy what they couldn't control, central banks were adapting, incorporating elements of cryptocurrency design while maintaining monetary authority. We're witnessing the financial equivalent of the Cambrian explosion, noted evolutionary economist Rebecca Chen. Multiple monetary species competing in a complex ecosystem, with hybridization between legacy and emergent forms. For Bitcoin, this marked a transition from existential threat to competitive challenge, still dangerous, but survivable. By March 2026, Bitcoin had stabilized around $82,000, a devastating drop from its peak, but far from the complete collapse many had predicted. This new equilibrium reflected both Bitcoin's demonstrated resilience and its diminished near-term prospects. The survival came with significant costs. Regulatory frameworks accelerated globally, ending the era of cryptocurrency exceptionalism. Compliance requirements fragmented the market, with clean Bitcoin fully traced through regulated channels, trading at a premium to anonymous coins. The vision of Bitcoin as a completely sovereign, state-resistant asset had been compromised. Yet in fundamental ways, Bitcoin had prevailed. The network continued to produce blocks. The 21 million coin limit remained sacrosanct. No central authority could unilaterally change its rules. What doesn't kill Bitcoin makes it stronger, quipped financial commentator Max Kaiser during the crisis. History suggests he wasn't entirely wrong. Bitcoin had demonstrated anti-fragility, the ability to gain from disorder that Nassim Taleb identified as the ultimate survival trait in complex systems. The systemic shock accelerated Bitcoin's evolution in unexpected ways. The collapse of weaker cryptocurrencies consolidated Bitcoin's dominance. Institutional investors, though initially fleeing, returned with more sophisticated risk management frameworks. Most significantly, the crisis forced a clarification of Bitcoin's role in the global financial system. Before the crisis, Bitcoin was trying to be everything: a speculative asset, a medium of exchange, a store of value, a financial network, and a political statement, explained monetary theorist Francis Coppola. After surviving systemic collapse, its identity crystallized around its most defensible function: digital gold for the information age. This specialization strengthened Bitcoin's resilience against future shocks. By focusing on store-of-value properties, scarcity, durability, fungibility, and verifiability, Bitcoin carved a sustainable niche in the monetary ecosystem. The systemic collapse of early 2026 wasn't just a test for Bitcoin. It was a stress test for the entire concept of decentralized finance. From that crucible emerged 4 enduring lessons. First, technological decentralization doesn't guarantee market decentralization. Despite Bitcoin's distributed architecture, market dynamics remained vulnerable to concentration of ownership, exchange, dominance, and herd behavior. Second, financial systems cannot escape the jurisdiction of sovereign powers. While Bitcoin's protocol continued operating regardless of legal status, its practical utility and market value remained tightly coupled to regulatory frameworks. Third, monetary competition drives innovation across all currencies. The features that made Bitcoin resilient, transparency, predictable supply, resistance to debasement, are now being selectively incorporated into both traditional currencies and regulated stablecoins. Finally, and most profoundly, the collapse revealed that money is ultimately a social technology. Bitcoin survived not just because of its elegant code or economic incentives, but because enough people believed in its continuing value despite overwhelming pressure. Throughout history, observed economic anthropologist David Graeber shortly before his death, the most successful currencies have never been those with the strongest backing, but those that captured the social imagination. As Bitcoin rebounded from its brush with systemic collapse, this truth became undeniable. The narrative of Bitcoin, its origin in financial crisis, its resilience against opposition, its embodiment of digital sovereignty, proved as important to its survival as any technical feature. In the end, Bitcoin wasn't just surviving, it was being reborn, scarred but strengthened, compromised but clarified, no longer a revolutionary promise but a tested reality. Whether this transformation represented Bitcoin's ultimate victory or its subtle co-option remains the great economic question of our time. The only certainty is that Bitcoin, having faced systemic collapse and survived, will never be the same again. Neither will the financial system it sought to replace.